Hi, my name is Roy Rumbo. I'm an accounting professor at the University of North Texas, home of the Mean Green. And I teach intermediate accounting courses 1 and 2 there. And today's lecture that I'm publishing to YouTube is the purpose of this is I'm doing this for my accounting 3110 students at the University of North Texas. I do make it public. Maybe there's a few people that might be helped by this. I think I saw someone comment on one of my previous lectures from New Zealand. So I guess it's global, but guess what? I am not a YouTube star, probably not going to be a YouTube star teaching intermediate accounting. But again, my goal is not to make money here. It's just to help people by making these lectures public. So let me first acknowledge McGraw-Hill, the publisher of the textbook, whose materials I'm using. Textbook is called Intermediate Accounting, and it's the Spicer Nelson Thomas book. I think it's a 10th edition or something like that. So great book. I love teaching from it. And again, using their materials. So with that, let me get to work here and get started. I'm going to share my screen. And let's go. So this is chapter 9 in that textbook. And this is the second chapter and my second lecture on inventory. Because inventory is crucial. Again, just to repeat myself from the last lecture, inventory is a special asset, and these are assets that either we buy or that we manufacture ourselves in order to sell to customers. That's the only purpose of inventories. And so why is this so important? Because as we sell the inventory, we no longer own it. It's delivered to the customer. At that point, we record revenues, but we also record a special expense called cost of goods sold. So inventories and cost of goods sold are pretty much directly related. And so cost of goods sold, one of the largest expense items on the income statement. And we especially look at revenues minus cost of goods sold equal gross profit. It's a subtotal on the income statement, and it tells a lot about the company. And usually we will express it in percentage terms, gross profit divided by net sales. And a high percent gross profit means, probably a more profitable company. It also says something that they're buying stuff cheap and selling it at a much higher price. How can they do that? Maybe they have a brand. Maybe they have a really good position in the market. So a high gross margin a higher gross margin from one company versus the next in the same industry can tell you something about their position in the industry, and you want to invest in companies that are successful in their industry. And now in this second chapter, we're going to get into some, more, some complications, if you will, that I guarantee you've never seen in your introductory course, certainly not in the introductory accounting courses that I have taught at UNT. And so I'm going to do a multitude of these and look at some other ways to measure cost of goods sold as well. So this first part of the chapter, we're looking at, after we've already purchased the inventory, we've debited inventory and credited accounts payable cash, things happen. Circumstances arise after the production. And what could happen? Well, because of these issues, the ones we care about, the inventory could sell for less than its cost. And if that's true, we're going to have to record that reduction in value, when it happens. And so it's, again, as all accounting is, it's about timing. What kind of things could happen? Maybe the inventory got damaged, it got dented by a forklift out in the warehouse. Could be physical deterioration. How about, I like to use oranges at Kroger as an example. Well, guess what? They don't sell, they go bad, and so they could be some deterioration in the product. Obsolescence, you see this a lot in high-tech companies, in computer chips, whatever. Maybe they produce a whole bunch of computers with one type of computer chip that they think is fast at the time. 6 months later, someone's got a faster one. And so those old ones, they're not going to sell as much. Think about the iPhone. You got the iPhone 13. Well, immediately iPhone 11, iPhone 10, they go down in value, right? And so if you're holding those in inventory, you could have some obsolescence associated with that. or changes in overall price levels if pricing goes down. Whatever, reduced ability to sell. And generally accepted accounting principles require companies to take a look at their inventory at the end of each accounting period and double check, triple check, has some of these inventories lost values, and what we care about, have they lost values lower than what the historical cost was. So the historical cost of that is what's on our books now for inventory. And so if it's less than cost, we're going to have to do what's called an inventory write-down. And we're going to credit inventory. Some people keep a special account separate for this, for write-downs like this. They have it, sometimes referred to as inventory reserves. For this, the textbook example, which is different sometimes in practice, you're going to credit inventory. And when you credit inventory, reduce inventory, you're going to debit an expense, the cost of goods sold, or a loss of some sort. Now, there's two ways we approach this, because what is the amount of the inventory write-down? And unfortunately, for you guys learning these materials, be good if there's just one approach for all types of accounting. Well, if the company is on FIFO or average cost, or anything besides LIFO in the retail method, they use what's called the lower of cost or net realizable value. And that is contrasted to lower of cost or market. So if you're in LIFO or retail, so if you have a multiple choice question, the first thing you got to decide on an exam, is the inventory based on a FIFO or average cost, or a LIFO or retail method? If it's LIFO or retail, you got to think lower of cost to market. If it's under FIFO or average cost, which is most of the ones you'd see in my course and in my exam questions, it's going to be the lower of cost or net realizable value. And so here, market is going to be different in this terminology than net realizable value. Many times we'd say, hey, what's a net realizable value? That could be the same as the fair market price. But in this case, when we're talking about inventory, these terms mean something different, especially when they're associated with lower of cost to market or lower of cost or net realizable value. And we'll look at these. So let's look at the FIFO and average cost inventories first. And this is the lower cost or net realizable value. This one is pretty easy, not a lot of complexity here. The net realizable value is what we think we can sell it for. And we'll know that because some of these products might be selling right now and we know what they're selling, but we're going to subtract any costs to complete, dispose, or transportation costs. Any cost of completion, I think about as cost to complete the sell, if you will. And so it's kind of look at it, the net amount the company expects to realize or collect in cash. And so what are some of these costs of completion? It could be selling commissions. It could be freight to the customer if we have free shipping. So any of these costs and they have to be directly related to the sell of the product, estimated selling price minus these kind of costs, which would be pretty much common sense, I think, when you look at the examples. And so at the end of the year, the company compares the cost on its books right now, the ending inventory, and you compare it to the NRV. If the NRV is lower than the cost, you've got to record an adjusting entry. You're going to have to reduce your inventory, credit the inventory, and you have to debit an expense. If the cost is lower than NRV, meaning the NRV is higher than the cost, you're done, because this is the lower of cost or net realizable value. So if net realizable value in this whole mathematical exercise is higher than cost, then you record at cost. If net realizable value is lower, you record at net realizable value. I'm going to start saying NRV, okay? Net realizable value, NRV. And the textbook's doing the same thing. So adjusting cost to NRV, here's an example where the cost was $415,000, but the NRV was $395. Therefore, we're going to have to write this down. Credit inventory for $20,000, debit cost of goods sold for $20,000. And it says here, if it's really a big and unusual item, you might not throw it through the cost of goods sold. You might have a special loss and maybe a separate line item on your financial statements. Would make it more user friendly for the market. Okay, next, now we're looking at companies that are LIFO or on the retail inventory method, which we'll get to. We're going to learn the retail inventory method, fun stuff later in this lecture today. So lower of cost or market. So again, market is different than net realizable value. We're going to look at net realizable value, but that's going to, become a ceiling. So we're going to look at the market. Usually is referred to as the replacement cost. You'll see that on the exam, the replacement cost. Well, now we have some nuances here that makes this hard, because we're going to look at the net realizable value, same definition that we just looked at, selling price less cost to sell, and that's become the ceiling. So if the market is higher than this NRV, then the market cannot be higher. We're going to use the net realizable value. If the market, and let's look at the floor, and the floor is the NRV minus a normal profit margin. So if you make 30% normally as a profit margin, I do the NRV minus 30% of the NRV, and I would have what's going to be referred to as the floor. So this is why it's hard. The answer to the market, lower of cost of market, could be net realizable value if the market is higher. It could be the market if it's in between the ceiling and the floor, and it could be the NRV minus a normal profit margin if the market is lower than the NRV and the normal profit margin. So you really could have three possible answers for market. And then we're going to compare costs to that final answer on market. And then we're going to record, whichever is lower is our inventory value. Again, same thing here. If our inventory was 415,000, but the market was 387, we're going to record a loss. Just so the journal entry is exactly the same, whether you're doing lower cost or NRV or lower cost of market. And I'm going to work some problems in the next lecture that we'll take a look at this. So that kind of ends the whole subsequent issues for inventory and writing inventory down. So now in another section of this additional issues chapter, and we're going to look at the gross profit method. And it's a way of estimating ending inventory. Why would we ever have to estimate ending inventory? Well, maybe the inventory was lost, stolen, or it was destroyed in a fire. And so we've got to have a way of coming up with the financial statements, given how much inventory got lost or stolen, because it's too late to count it. It's gone, or it's burned up, or we had a tornado hit one of our factories at Lenox. And so a lot of things could happen, and we're going to have to estimate the inventory and the cost of goods sold. And so, and the auditors will be looking at the overall reasonableness of your calculation. So let's go look at the gross profit method. If we were doing this, the usual method of calculation under the periodic, we would have beginning inventory plus purchases equals goods available for sale minus ending inventory from a physical count, because we could do that if the inventory was still there, equals cost of goods sold. So this is really kind of an algebraic kind of expression here, if you will. X plus Y minus Z equals, N or whatever. And so we can rearrange this if we don't know the ending inventory. And it's a lot easier to estimate the cost of goods sold. Why? Because we know what our gross profit margins normally are. And so in the gross profit method, start with beginning inventory plus purchases and available for sale. And then instead of subtracting in the inventory, because we can't count it, we're going to subtract an estimate of cost of goods sold, and we'll get to ending inventory. Here's an example of that. So this company, beginning inventory 600,000. They knew their purchases, but they could get that from their accounting systems. And so they got 2.1 million available for sale. And so they're going to have to estimate the cost of goods sold. How do they do that? Well, they know their normal gross profit margins are 40%. So I'll just take 40, minus 40%. That's the profit margin, 40% of 2 million. So therefore, my cost of goods sold must have been $1.2 million. In other words, 2 million minus $1.2 million equals our normal gross profit. What we would expect on that inventory, on the sales of that inventory of 800,000. The normal 40%. That's a verifiable number based on history. And so now that we've estimated cost of goods sold, we can back into inventory. So available for sale minus cost of goods sold equals the ending inventory. Okay, what matters here in this gross profit ratio? How do you make sure it's relevant and it's reliable? It's a faithful representation back to chapter 1. Well, we want to make sure that we can support this. What we might want to do is group the inventory in the different pools of products that have similar gross profit relationships. And all the companies I work for, and I think probably most companies, if you have a lot of parts that are sitting around that are for repair, usually parts sales are higher gross profit margin than finished products. And unfortunately, companies make a lot of money when in repair, when you have to repair a product, and they make a lot of money on those parts because they have kind of a monopoly on those parts. If your Maytag washing machine breaks down, you just can't put any part in there. You got to get a Maytag part, and that might be cheaper than buying a new unit. And maybe you're frustrated, you want to get a Whirlpool or something else, but parts usually sell for a higher profit margin because of that monopoly. And so you might separate out your inventory between parts and finished goods, and then then go calculate on this. That would be a way to do it. Okay, all right, that's it. See, we're just doing just a whole bunch of little issues here, additional issues for this chapter. And so that was the gross profit method. Now we're going to switch into another subject, the retail inventory method. And this is an actual method allowed by generally accepted accounting principles, and a lot of companies will use this method. As I said, like high volume retailers, like a Target, might be doing that. And so you'll see the whole calculation. And in the next lecture after this one, I will work some problems around the retail inventory method, and I'll do some gross profit methods from the previous issue that we just discussed. And so step 1 in this, we're going to go calculate our ending inventory at retail prices, which we know because they're out there selling at those prices. And we're going to do kind of a cost of our good, almost like a cost of goods sold based on the retail prices, which I know is not accurate, but this is the information we know. So we'll calculate goods available for sale at retail and minus sales at retail. And then we're going to use the cost to retail percentage. And so what's the cost to retail percentage? That's cost goods per available for sale at cost divided by goods available for sale at retail. And we'll know this because we'll know what our inventory, we started with. We know what inventory we purchased at cost. And based on this information here, we'll know for goods available for sale at retail. And then we'll be able to calculate, guess what? Ending inventory and cost of goods sold. So it almost looks like another version of the gross profit method. The only thing I'll say, because we're using percentage, we are going to estimate inventory first and then get the cost of goods sold. That would be different than gross profit method. But here we're using this percentage, this cost to retail percentage to estimate, kind of like we use the gross profit margin percent in the gross profit method. So, very similar. So here's the information we know. These are fact-based. We know how much we started with in inventory at historical cost. We know how much we purchased, and there's goods available for sale. Using our really good retail inventory system, we'll know what these are selling for. So we'll know beginning inventory, the retail of that is 100,000 plus the purchases of 460 at retail prices, not at the cost, equals 560. So we just take 347,200 divided by 560, 62%. Now, so this is all fact-based, and now we're going to use this information to go calculate our ending inventory. So let's keep going down the retail method. We're going to subtract our net sales, which we also know this is another fact-based thing. And so we say 560 minus what we sold, ending inventory at retail is 160,000 at retail prices. Well, what is it at cost? Oh, easy. 62%, we just use this percent here, times 160. There's our ending inventory at cost, 99,200, which is 62% of that. Now, this is an estimate here, and subtracting that from the cost available for sale minus ending inventory back in our normal periodic inventory calculation of cost of goods sold, 347,200 available for sale minus the ending inventory at cost now, our estimated cost, and now we've got our cost of goods sold. Again, this is used in practice. If you end up in a retailer, you're doing the accounting for a retailer, you're going to want to know this, or maybe you're auditing a retailer, you're going to want to know this. And so as an auditor, you'd want to like really key in on this percent and all this data to make sure it's accurate, because that is going to generate the cost of goods sold, the biggest expense on the income statement. Now, there's some other things happening in the retail world we got to keep in mind. We're going to have prices marked up from cost to selling price. We might, I never see this much, we might increase the price subsequent to that initial market. Maybe people could be doing it now, and inflation, they may be marking up their goods because they know they can get more money for their products. But to me, I don't think you see much this. And then you could cancel your markup to bring it back down. So if you go into any clothing a retailer like a Nordstrom or whatever, man, they're marking up and marking down every day. And usually if the goods sit there long enough, they start marking it down because it's not selling and they got to get rid of it. And a lot of people, it's kind of, you see something you like, I'll use women. If you see a dress or some really nice clothing that you like, well, if you want it now, you pay the price of that now. Now, what if I could wait 6 weeks? It's going to be marked down at a lower price if it's still there, right? And so retailers do a lot of markdowns of what's not selling. And then you could cancel the markdown. I don't think once you mark it down, it's kind of hard to go mark it back up. But this is all the kind of things that could happen. Why are we talking about this? Well, it's going to matter because I'm trying to get to this percent, and these retail prices are changing all the time. So we've got to account for these markups, markdowns, and all of that. And here's an example of the stuff I was talking about. We bought this at $6. We've marked it up by $4, got it to 12, additional markup. And then we canceled the markup and we ended up selling it at $10.50. Here we got it at 6, marked it up, and then marked it down. And so, and then it sold at 8. So you see how the prices are changing on the retail floor due to markups, cancels of markups, markdowns, cancel the markdowns. Every day it's kind of changing. So let's go look at an example. And I think it's better to learn this from the example than just the slides. But let's go look at an example here. So the home improvement stores, maybe that's Home Depot, I don't know. They're trying to calculate their ending inventory And once they know their ending inventory, their cost of goods sold using the retail method. And so here's some data to know that here's the facts that we have, if you will. Beginning inventory at cost, 99,200. Net purchases, 305,280. And we have beginning inventory at retail, 160. Net purchases, 470. So we can go easily calculate available for sale. But now we're going to have to deal with the net markups less cancellations, 10,000. Net markdowns less cancellations. And so we've got that data from our system, 10,000 and 8,000. And we also know that we sold 434,000 at retail. So we're going to use these retail numbers and our percent to go calculate the ending inventory. So now, all right, this is, we just never make this stuff easy, in inventory because companies use different cost flows. And so, guess what? We have an average cost retail method. We have a FIFO retail method, and we have a LIFO retail method. And guess what? Even worse, dollar value LIFO retail method. So it's just crazy. And I am not going to cover in this lecture the LIFO retail method or the dollar value LIFO retail method, because I'm not going to test my students on it. Now, if you're watching this in YouTube and your teacher may test that, you better go get the textbook and learn it. The second reason you might pull the textbook out, I kept my intermediate textbook for when I started working. You may be auditing a company using the LIFO retail method. And it's, once you know the average cost of the FIFO, you'll figure it out. So I'm not too worried about you getting out into the working world and never having seen the LIFO method, because it's just a slight variation of what we're doing here, with some LIFO complications. So I'm only going to look at the average cost and the FIFO method. And there's really just one big difference between the two. In the average cost, we include both markups and markdowns in the percent calculation. In the FIFO method, for the percent calculation, we do not use markdowns, and you get a slightly different answer. So I probably could go in a long dialogue of why, but I'm not going to. Just learn how to do the average cost, learn how to do the FIFO method. So here's our available for sale for cost. We know this from our beginning inventory in our accounting system. We know what we purchased because we have controls around that. We're buying that, and it's 404,480. And we also get from our system beginning inventory of retail plus what we purchased. And now we're going to add the markups, subtract the markdowns, and we get to 632,000. Now, we've got the data we need. Do the cost of retail percentage, and that is just 404,480 divided by 632,000, 64%. Now, we also know from our system, we sold 434,000. Obviously, that's at retail because that's what we sold it for. And so now we're going to do estimated ending inventory at retail. That's just 632 minus 434, 198. And if we know ending inventory at retail, well, then we can also know our estimate for ending inventory at cost, because we have this percent. We know the relationship between the cost and the retail. And we assume that relationship exists on this ending inventory of 198. So we take 198 times the 64%, and we estimate ending inventory at 126,720. That's what's going to go on our balance sheet, and we'll record. So how do we're going to, that's where we need to end up. And so again, we also know our cost of goods sold, right? Because 404,480 minus ending inventory 126,720, there's our cost of goods sold. I think this makes sense. The problem with this chapter is we just throw a lot of these at you and then figure it out, kind of thing. Now, this is what's called the conventional retail method. And so since it's conventional, I said FIFO before, but I think this conventional is one that's probably used more because it's referred to as the conventional method. And the only difference here, here's the same data, by the way, that we had before, is that you add the markups for your percent calculation, but you don't subtract the markups. And so you're going to end up, as we can see, with a higher cost of goods sold because you have a lower percent for your ending inventory. Lower ending inventory, higher cost of goods sold, just the way the math works here. So I don't ask me why. I think this is conventional, maybe the preferred method because it's more conservative, meaning it's going to result in a higher cost of goods sold. So don't forget here that the markdowns are not included for the percent calculation, but you still need to include them to get to the final estimated ending inventory at retail. Note 198,000 here. Let's go to the other method, the average cost method, 198,000. So sorry about that. So note, nothing changes here on the retail side in how the numbers add and subtract to get to 198. The only thing that changes is the net markdowns are not included in the formula for the cost to retail method. Only the markups are included. So this is a lot of stuff, basically to memorize for the exam on this course. And so I get it. This is a lot of materials and it's tough. And for my class, you may have to work a problem or multiple choice around this. So you better be ready. So now we have, instead of the last one, we had 64%, a higher percent, because the 8,000 reduced the denominator. In this case, that 8,000 does not reduce the denominator. So 404,480 divided by 640 is 63.2%, lower than what we'd have got in the average method. Now I take the 63.2% times the ending inventory at retail, and I come up with 125, 136. Again, smaller ending inventory, larger cost of goods sold, 279 versus 277. And so I think, most likely, and I don't know, I've never worked at a retailer, but I would imagine since this use the word conventional, this might be kind of a preferred method that you would see more than the average cost method. But again, all disclosed in the footnotes, which you use. And so you want to know, oh, they're using the conventional method. So comparing two companies, their cost of goods sold might be higher. And so it's good to know this kind of information as a retailer when you're comparing two companies using different methodologies. Okay, now we're in another topic here, and this is around changes in inventory. So, we could change from the average cost to FIFO or FIFO, and who knows why companies went. This does not happen very often because number one, it's a lot of work for the company to do. And so there's going to be some big reason they might want to change. Maybe one of the divisions, they purchase a company or whatever, and they let them keep their own, and maybe you're trying to standardize. So there could be a lot of different, more unusual reasons to change your inventory method, except if you're changing the LIFO, that especially back in the 70s was very common in a high inflationary environment. We may see it more common as we start to see an inflationary environment now in 2022, that there are a lot of companies change the LIFO. Again, why? Go back to the last chapter. Larger income tax deduction in rising prices, higher cost of goods sold. So now, we think about changes in accounting policies, and there's a whole chapter on this for intermediate too. So this is kind of a slight introduction, and there's two methods. One's the prospective method, one's the retrospective method. And so if for most inventory changes, you have to use the retrospective method to account for the change. Means you got to revise all the financial statements that you're showing. Usually, and the SEC requires this for public company, you provide 3 years of income statements and 2 balance sheets. So those 5 financial statements would have to be revised. So you have to go to last year's income statement and the income statement from 2 years ago and act like it was on the new accounting flow. And you got to revise all of your statements, and you got to do a lot of disclosure. By the way, that is a tremendous amount of work, and that probably helps prevent companies from changing their inventory methods too often. Now, if you change from a FIFO or an average cost to a LIFO method, you really cannot go back in time and do LIFO. And so that is impossible. So in the change to LIFO, you just do a prospective, means you just do it going forward, and you do not revise that. Now here's some more information on the change to the LIFO method, because it's impossible to calculate prior years. You would not do that. And so we do not change it retrospectively. And LIFO is just used from that point going forward. Okay, we're getting close to the end here of this chapter. And this is, I call this, when I teach this is a friggin' head turner. Oh my God, inventory errors, and how do you correct these? And so, and we'll look at some of this, but if you have just think about it. If you have an ending inventory error, we'll get into this in a minute, then your cost of goods sold is going to be wrong. However, next year is also going to be wrong, because your ending inventory that's wrong is going to be your wrong beginning inventory next year. And therefore your cost of goods sold next year is going to be wrong. And that's why I kind of, creates some complexity here. So yeah, you could have a mistake in the physical counts at the end of the year, or maybe someone did not record a purchase accurately. There's a lot of things that can create inventory errors. And this is what I just talked about here, how this, and then your retained earnings would be wrong. If your cost of goods sold, if your ending inventory is wrong, then your cost of goods sold is wrong, and therefore your net income is wrong, and your retained earnings wrong. So an error in recording purchases or calculating inventory impacts 3 important areas, line items on your financial statements. 1, cost of goods sold. 2, net income. 3, retained earnings, because the wrong net income rolls into net earnings. And so when you're trying to correct this, it's just a nightmare. And this is what I call the big head turner. And you definitely could get a multiple choice on this, or even a problem, not from my class, but other classes. So let's just say the ending inventory was overstated. That's what the O means, overstated. U means understated. Well, this is why I call it a head turner, because, all right, I subtracted too much ending inventory, so therefore my cost of goods sold is understated. It should have been higher if I hadn't subtracted so much from the ending inventory. It was an overstatement. Now, if this is understated, guess what? My cost of goods sold is understated on my income statement. Therefore, I didn't subtract enough here. So therefore, my net income is overstated. And my retained earnings is overstated. Okay. This overstatement, as I said, rolls into next year's beginning inventory. And so next year's cost of goods sold is overstated. Why? Because I got a plus there, 800,000, that shouldn't be there. And so this rolls into an overstatement here. If cost of goods sold is overstated, then net income is understated. Now, guess what? Retained earnings now is correct, because I have the overstatement in net income last year minus the understatement this year. And so in 2 years, this would correct itself. Oh my God. Think about the exam questions that you could ask. It's pretty, I gotta admit, these are kind of evil exam questions. and I wouldn't do a bunch of them, but might have to throw one in there for my students. All right, just say, hey, ending inventory is overstated in 2021. What was the impact on net income in 2022? So now you got to go through all of this. And usually when I'm working these myself, I just write out the formulas over and do it all the way through, just like this is done. Because, I may be just not smart enough to say, oh, that's overstated, and just get right to that answer right off the top of my head. I usually write it out on a piece of paper. So that's enough for inventory errors. I think one thing it is important to know, how important that ending inventory is. That when you're doing physical counts and a physical inventory end of the year, it's really important to get that right, because it affects so much of your accounting and your profitability. And if it's large, you may have to come back, and you find it later, you may have to come back and tell people, hey, our income statement was wrong last year. We've got to restate that. That if you're the accountant for that company and you were at fault for that, or you're in charge of the accounting for that company, it's bad news. You might be looking for another job. Okay, a company could have made some significant purchase commitments that it obligates the company to purchase a specified amount of merchandise or raw materials at prices in the future. Now, why would we do that? Number one, we want to guarantee that we can get that product, and we want to guarantee the price it is now, not a future price. So as it says here, protects the buyer against increase in purchase and provides a supply of products. So the same thing I just said. So inventory is recorded at the lower of the contract price or the market price of the date. I just throw this out here that you could have to record a purchase commitment as inventory at some point. And that's the end of chapter 9. Again, now we finished 2 chapters of inventory. And why does it matter? Because when we sell that inventory, it becomes cost of goods sold, the largest line item on our income statement, and an important one because it's used in calculating the gross profit margin, gross profit percent, which is highly useful for investors to have some knowledge and understand the story, business story for your company. And I like to look at gross margin trends. So if gross margins are going, it'd be very interesting now in a period of inflation, are gross margins trending up because companies are getting more pricing than their own cost increase, or gross margins, what we call getting squeezed, getting lower because they got cost increases in inflation, but they can't pass those along in their pricing. So you could see some companies getting squeezed. Some companies, they're getting higher costs. They're just going to pass that right along to their customers. Who can do that? That's a company with a very strong brand, with confidence, with a position in the market. So looking at the trends on gross profit margins can tell you so much about a company and whether you want to work there and invest there. So with that, I am signing off on this lecture, and I thank you for your participation.